Hi friends, I'm back with one more video. So this time we are back with the series on calendar. If you look at this slide, it says strategy number 2. So already we have discussed the strategy number 1 in one of the live streaming session. This video is going to be the strategy number 2, which is the diagonal calendar. Do not go on the naming convention. Stay with me, you'll get to know. We will be discussing about the strategy number 2. So I have like 2 to 3 strategies, or maybe like 3 to 4 strategies. We will make 4 different videos. So this would combine the complete end-to-end package on the calendar. So before watching this video, just in case if someone wants to know what is the strategy number 1, what I would recommend is go to my YouTube channel. So if you look at my YouTube channel, you have my Telegram handle over here, hybrid trader. Search for hybrid trader. You will be like land up to this page. You will have this logo, so wherein we will be discussing about too many things in my Telegram channel. So wherein I'll be like discussing with you all the polls. So we'll take like different polls, like these are all the Q&A sessions. Like if view of the market is super bullish, you will go for what, right? What strategies will you go? So these are all the different Q&A sessions, and also I'll be giving you the answers also. This is not something like I'll be just sharing the questions. Along with the questions, I'll be sharing the answers. See, these are all the see, if loss is on the C side, then will you sell a PE, buy call, or sell the deep OTM? Don't know, right? Just in case if someone don't know the answer, I'll definitely provide the answer for them. And along with this thing, I'll share my view of the market. I'll be sharing the, let me show you, right? I'll be sharing you the my trade logic. So this is the calendar spread what I've deployed like 2 days back. I'll be sharing you all my trade logic. I'll be sharing you with the chart analysis. How does the Nifty look, whether it is like bullish, bearish, right? This is my what do we say, the Telegram channel. And also if you look at the banner page, you have an icon wherein you will be like landed up to the Twitter ID. So this is my Twitter page, right, which is like hybrid trader 04. So even here we will I'll be discussing with you the view of the Nifty, right, bank Nifty, right? I'll be like sharing all the videos on the Twitter also. So I would recommend you to join my Twitter and also the Telegram. Okay, and then come back to my YouTube channel, go to the playlist. Okay, if you go to the playlist, you will be finding you'll be finding a series on the name calendar. One second, this is where I find very difficult. Okay, 1 second friends, 1 second, give me a second. So this is very important. Go to my channel. Okay, you can just go to the playlist. Right, in the playlist you have this calendar, the calendar end-to-end series. Okay, just go to this end-to-end series. You will have 5 videos, friends. You will have 5 videos. Okay, let me click on this thing. You will have 5 videos on the calendar spread. So this is what we have discussed last Sunday, ABCD of calendar. So wherein we have discussed about the strategy number 1, which is your classic calendar. So I would recommend you to watch this 1 hour 27 minutes video. This would be like eye-opener video for you. And then before watching this video, you should be watching this prerequisite video, which is strategies based on the India VIX, because calendar is all about taking the advantage of India VIX, the IV. So basically I wanted you to watch the video, this 35 minutes video prerequisite. And also I've made a video long back on psychology of the calendar. How will be this the calendar behave when we have the calendar edges with this triangle, and also how about retaining the calendar edge. So I would recommend you to watch all these 5 videos and then come back to this video. Every video is interconnected, so you need to just connect those dots. Okay, so let me quickly take you to sensible. Okay, I'll take you to the sensible. We'll just go for strategy builder. So we are going to discuss about the strategy number 1. As I mentioned over here, we are going to discuss about the strategy number 2. Sorry, the strategy number 1 is the classic calendar. Already I've told you, right? You have a 5th video. Watch the 5th video. Okay, let me take you to this thing. So we are going to deploy the calendars on Nifty, not on the bank Nifty, because whenever we go for the calendar, what is calendar basically? Calendar is any strategy of this week, and we are going to edge with next week. So when you go for bank Nifty, only the 500 strikes will have the liquidity, right? Bank Nifty, though it is like highly traded instrument, but when you go for the next week calendar edges, you'll not find the liquidity. So Nifty will not have that issue. Nifty will have like more liquidity, so for that reason we go for the Nifty. Okay, what is calendar? So today is what, 16th, so we are going to deploy the calendar for the next week, because we have only 2 days. See, today is what, today is Tuesday, tomorrow and day after tomorrow is the expiry. So we are going to deploy the 25th week expiry, and then we are going to buy the calendar edge of the 1st of August, September. Okay, 25th would be a expiry, 1st would be your calendar edge. Okay, I'll go to the strategy builder, I'll go for 25th. So see, whenever I go for, see, basically what is calendar, I already discussed in that 1 hour 25 minutes video, friends. I'm not going to repeat everything, because if I repeat again the video will become lengthy. So I wanted you to watch all the ABCD of calendar. I'm not going to repeat anything, because I've told everything in this ABCD of calendars. Okay, how to select the premium, how to select the strike. If I start describing everything, so there is no point. Now this will be like unnecessary duplicate. All right, so my calendar would be right on 25th. I'll go for any premium which is at 30 rupees, because today is what, today is Tuesday. If it is Tuesday, I'll go for 30 rupees. If it is for Wednesday, for the 25th expiry, okay, Tuesday for the 25th expiry, I'll go for 30 rupees premium. If I'm just deploying tomorrow on 17th for the 25th expiry, I'll go for 25 rupees premium. Okay, I will sell a put 30 rupees, and I'll go to call side. I'll check for anything which is at 20. Okay, so let me see, let me select this 25 rupees. That's it. So this is your typical strangle. Okay, and now to convert this to calendar, what we have to do, we have to buy the edges of next week, that is the following week. Add, go to 1st of September. Okay, so what is diagonal calendar? So so what is the premium we got? 30 rupees, right? Let me select, let me buy 31 rupees, and also here we bought it for 25 rupees, right? So let me buy it for 27. That's it. I'll show you, like, stay with me, right? This is your typical calendar. 2 sold positions of current week and 2 edges of next week, right? This is your typical calendar. Now the actual fun begins, the actual logic begins. Now, how much of premium did we collected? Right, we collected a premium of 30 rupees from the PE side, we collected a premium of 25 rupees from the PE side, right? How much of premium we paid? We paid 31 rupees on the PE side, we paid 27 rupees on the CE side. Absolutely right. So now, one second, so what is the spread difference, right? 17,350 is the sold position, and what is the buy position we got? 17,050. So what is the difference between this thing? 300 rupees, right? This is the 300 rupees, right? And what is the sold with the call? 18,250 and 18,500. So this has basically the difference of 250. Okay, this has the difference of 250. So I've learned from one of my guru, right? This video I've learned from one of my guru. So what he says is, whenever we go for calendar splits, see, basically why do we go for calendar splits? I've explained each and everything in that 120 minutes video. I'm not going to. Basically the crux is we go for calendar to get the advantage of rising wicks, because whenever the wicks rise, right, whenever the wicks rise, so this premiums, the bought premiums 18,050 and 17,050, this will increase like 2 to 3x times when compared to a sold position, because the increasing wicks, I wicks is I premium. So whenever the wicks increases, your premium of the buy position will also increase. So do you think, do we need to have 300 gap difference and 250 gap difference between your sold position and your bought position? No, right? So we wanted to make the calendar edge as close as your sold position, so that whenever the wicks increases, right, whenever the wicks increases, so your calendar sensitivity will increase. So if let me show you one example. Let's say this is your typical calendar. Market stands somewhere here. Okay, all of a sudden market falls like 300, 200 points to 200 points. Simple, friends, right? So just check the combo of PE now. So what is 17,350? We have 17,350, right? We have 17,350 and 17,050 is your buy, right? Just discuss about 1 and 2 as a classic example. Market fell down for 200 points. So what will happen? Do you think this will become in the money first, or this will become in the money first? obviously, right, this will become your in the money 17,000 because market is falling down. So this will become in the money, and this is a bit of OTM. So whenever the market falls quickly, what happens? This becoming in the money, you will get into panic mode because your sold position has become in the money. The premium, and moreover the VIX is rising. Whenever the market falls, your VIX will rise, right? So this rising VIX will increase the premium of your sold position like nothing. Do you think the premiums of the 17,050 will increase? No, because this is OTM. This has become in the money. The in the money leg will start giving you the panic. With the rising VIX, this will rise 2x times more than the rise in your buy position. So for that reason, what you have to do is like you have to make this calendar edge very sensitive. Like it should be like very close to your sold position. So let's say let me delete everything. So friends, this is going to be like very important video, so I'll not put any time check, be it like 1 hour or 1.5 hours. If required, I'll put it into 2 different parts, but I'll try to cover the entire concept. So what if you make this calendar edge very strong, meaning what I'll do 17,350, I'll just make it to let's say 17,150. So now the difference is 250. Okay, so 100 rupees we have reduced. At least this calendar leg has become very sensitive. So even if you make it to 17,300, let's say 17,300 let's take an example, right? Every time getting 17,300, you have to pay more debit. See, you received 30 rupees and you're paying 56 rupees. This is not at all feasible. That's what I'm telling. This is strategy number 1. I'm going to discuss about the strategy number 2, strategy number 3, strategy number 4. This will be like complete end-to-end package. All right. So just for the demonstration purpose, let's take an example. Okay, if you have 17,300 as a buy, as a calendar edge, and 17,350, same example. Let's say market stands here, 200 points market has fallen down, right? Now this, though this will become the in the money, but even this is like as close as to your sold price, right? So when this is increasing, this will increase also, right? When this is increasing, when your sold position, because market falling, VIX will increase. Increasing VIX will increase the premium of your sold position. At the same time, the increasing VIX will increase the premium of your 17,300, right? The premium is only 30 rupees, but the premium is here what? 56 rupees. So don't you think this will increase in a double speed to some extent? So whatever loss you see in your sold position, the loss will be completely mitigated by your buy position, because this will increase in 2x speed. This will increase in 1x speed because the premium is less. You're collecting more debit. What is more debit? Whenever the VIX increase, this will increase the premium. So you have almost double the debit of your sold position, right? Every time getting 17,300 premium is not feasible. Just for the demonstration purpose, I'm telling you, but I'll let you know how we have to select the what do we say, the premiums. Okay, let me delete everything. Now what I'll do now, so we got the 30 rupees, right? So what if, so tell me one thing, friends, pause the video and tell me one thing. This is very important. Already we have discussed. On 25th of August, this can become 0, right? If this becomes OTM, this can become 0. Let's take an example of this one, 17,300. On the same 25th August, will this premium become 0? Will this premium become 0? Give me honest answer. Pause the video and give me an honest answer. Because I'm talking about 25th, I'm not talking about 1st September. Though we have taken the edge of 1st September, but my question is, on 25th August, on the expiry on the 25th August, if this is OTM, this can become 0, absolutely. But will this become 0? My question is, will this become 0? No, because if this has to become 0, this will become 0 on 1st of September, not on 25th of August. So what does that mean? So out of 56, we might end up seeing at least 10 to 12 rupees of the premium, or 10 to 15 rupees of the premium, which will become 0 only on 1st of September. But maybe on 25th of August, this 56 might become 10 or 12. but this will not become 0 on an extreme case. This, if this has to become 0, this will become 0 only on the 1st of September. Already I've discussed many times, watch those videos. Now taking this into consideration, can we give some extra premium for the buy position rather than exactly matching with the 30 rupees? Can I give like 36, 37, right, so that my buy position is also close to my sold position? Okay, let me check. Okay, this is 50, 40, 38, 150. Right now, see, check the beauty, right? We have 150 rupees, 17,350. Now what is the difference? Earlier the difference was something like this, right? We took 30 rupees and 30 rupees. The difference was almost 300 rupees, which is not good for us, because we have discussed, because this will become in the money, this will not protect you. So what I'm trying to do, I'm just trying to increase the premium. So 30 rupees we received, sorry, we gave, and 30 rupees, 34 we received, 4 rupees. Let me try it for one more 50 rupees, right? 38, absolutely. Even if I give like 8 rupees extra, anyways on the expiry, on the 25th of expiry, this 8 rupees will be remaining. So though we are telling that we are giving 38 rupees of premium debit, but ideally technically we are just giving 30 or 32 rupees, maybe 6 to 8 rupees will be pending, will be left on the 25th, because if this has to become the 0, this has to become 0 only on 1st September, right? So now check the difference. Now we have 200 difference. Perfect, friend. So 200 points is sufficient for us. Okay, so don't have more than 200 points difference. Now let's go for call side. 25 rupees is what the premium we paid, right? Because it's a sold. What I'll try to do, I'll check for 30 rupees now, right? Now 250 and 450. Perfect. This looks perfect for me. This looks perfect for me, right? We are giving additional how much? 10 rupees, 9 or 10 rupees. But let me do one thing. Let me go for 33 rupees. Okay, let me go for 33 rupees now. So 18,200. Let's balance the premium. Initially we took 25. Let me took 33 rupees, and then let me go for this one, 40, 33 and 47 rupees. Perfect, friend. So this is, so we have 200 difference between your put, 350 minus 150, 200, which looks absolutely fine. 18,200 minus 18,400 minus 200 difference, right? This is your typical calendar spread. We are able to come up with our calendar spreads, right? And then we can just go ahead and deploy this calendar spreads, and now we will discuss about this strategy. You got my point? So this much of time I've just took to explain you, right, what is the premium we have to select. If let's say today's Tuesday, right? If whenever you are going for Tuesday, go for 30 rupees premium, and then go for same premium, or else if you get the same premium, let's say if you're getting 30 rupees by giving a debit of 30 rupees, and if you're getting 17,150, you can just blindly go and deploy the calendar spread. Same, you got 33 rupees, and if you're spending 33 rupees and you're getting 18,400, you can just deploy the calendar spread, because it all depends on the VIX. If the IV is high, you'll be not getting the next week edges at a low premium, because IV is high premium. But still we can give 7 to 8 rupees of the extra premium in terms of maintaining not more than 200 gap between your sold position, buy position, sold position, buy position, because you know, right, if this has to become 0, this will become 0 only on the 1st September. So we can just give like 6 to 8 rupees of extra debit. Now we are done with deploying the trade, right? We know, and let's say if you're deploying this tomorrow, so just go for 25 rupees, and you can give 30 rupees, just in case if you're getting at the 25 rupees, fine, or else you can pay 5 to 6 rupees more, so that you maintain the gap of sell and buy not more than 200 points. Now check the range and everything. You have 6% of profit, you have 22% of loss, but believe me friends, don't look at this 22% profit. Check the probability is almost 80% of the success you have, and slowly by doing the adjustments and everything, you will be able to increase this probability to 80-85%. Capital required is 50,000. You might need for single lot, you might need another 1 lakh or 70-80,000 for doing the adjustments. The more the capital, the better. Okay, now we will discuss. I'll do one thing, friend. I'll save this so that I can show you all the adjustments on the fly. I'll save this. I'll say test calendar. right? Test calendar, so that I can show you the adjustments also. Confirm and open in the builder. All right, will this work? Okay, let's see. Okay, let's see, or else I'll open the other tab. Okay, I'm not giving any time check, friend. I'm not giving any time check because I wanted to discuss each and everything. Again, I'm just showing you. I'll go for 25th. What did we do? We sold 30 rupees. Again, I'm showing you just in case if you want to see. We sold 30 rupees and then we sold 30 rupees call. That's it. And we went for next week. We went for next week for September. We bought it for how much? 38, I believe. And then we bought it for how much? 34 or 40, not sure. Let me show you. Okay, right, we bought it for 40 rupees, right? We have two windows open here. Right, so we've discussed about the maximum profit area. Now the actual fun begins. Okay, so now we are deploying the calendar splits just to get the advantage of VIX. So I'll show you one thing. I'll not do any manipulation. I'll just show you what will happen if the VIX increase. That's it. I'll not even manipulate. I'll not even change any of the strikes and everything. I'll just show you what will happen. Achha, before that, let me take you to the Greeks column. This is very, very important. Though the Greek says 190, though the Vega, the positional, the overall positional trade Greek says 190, technically this is as good as a, I can say Vega neutral, or else maybe this is like a sort of minute credit strategy, because you know, right, this there will be like pending of 8 rupees and 8 rupees, and that will become only 0 on the 1st of September. But anyways, we will be exiting our entire trade on the 25th, right? So for that reason it is showing Vega positive, but technically this is Vega neutral. Technically this is Vega neutral. Your delta is 0, you have less theta, because you know that theta keeps increasing as and when we go closer to the expiry, right? DK or leave it gamma, leave it about the gamma, because we will not be staying until the last hour of the trade. So Vega is, see, let me show you the theta, right? This is Wednesday. As and when we go, your theta will increase. Okay, let me show you just for the example purpose. See, Monday, okay, minus 61, and then 284, and then Thursday definitely that will become 0. Okay, so let me get it back to 0. Reset. Now we have seen the Vega. Though the Vega says 190, technically this is a Vega neutral trade. Coming to the graph, okay, what will happen? Check the range. We have 3.2% range on the downside. We have almost like 2.5% range on the upside. Safety wise, we are very safe, because Nifty 3.2% on the downside and 2.5% in the upside. Right now, I'll just increase the Vega with 10%. That's it. The moment I increase the VIX, what happened to your trade? Right, okay, let me again get it back to 0. This is very important to understand. So now your profit is almost cost to cost, minus 19. The moment you increase and keep the check on this 3.2 and 2.5, the moment you increase it to 10, right, simple, check your, we did 100, this is 10, right? The moment you increase it to 10, your profit has increased from minus cost to cost to 4,432, point number 1. And check your range. It has increased from 2% to 4.2%, from 1.5, 1.8 to 3.8%, just because the VIX has increased. This is the beauty of the calendar. Whenever we go for the calendar, we have to take the advantage of rising VIX. That's it. We do not have any other so-called strategy. This is taking the advantage of rising VIX. So I am expecting you to deploy the strategy when the VIX is low. When I say low, right, this is your 10 to 12, right, 10 to 12 VIX, and this is your, let's say, 25. I am not expecting you to deploy the calendar spread when the VIX is at 25. I am expecting you to deploy the calendar spreads when the VIX is between 10 and 12, or maybe at 14, or at max at 16 or 17. Okay, let me show you the VIX calendar. This is very important because I've discussed everything in my earlier video. Let me show you the VIX one more time, right? So now if you look at the VIX stands at 17. This is a perfect place for us to go for the calendar, because there are like only two probability now. Either your VIX can come down, If VIX comes down, I'll show you, you'll not get into panic because we are deploying the Vega neutral trail. If the VIX goes up, your trade will become profitable. I'll show you why. The decreasing VIX, the falling VIX will not be a threat for our strategy. Okay, now what I'll do, I'll get it back to, see, increasing VIX definitely from each, and see, your range will increase on the downside, your range will increase on the upside, your profit will increase in the between, your overall profit will increase. Initially, what was the profit? See, now we have the 15% profit. Initially, when the VIX was 0, what was your profit? Profit was only 6%. So double the profit. Now what will happen if I decrease the this is Vega neutral, right? What will happen if I decrease by minus 10%, right? I'll put a minus symbol here, right? I'll put a minus. See, you'll not get into panic situation. Your loss will be only 792. Check your loss, friend. Your loss is only 792. Though you have unlimited loss, but within the range, your loss will be only 792. Okay, let me remove this minus symbol, but with the increasing VIX, your profit will increase like anything. So that's the beauty, the way we have selected this strike. We made our Greeks Vega neutral. Okay, let me get it to 0. We made our Vega neutral. So increasing VIX will give you profit for your trade, double, triple, 3 times, 4 times, 5 times. Decreasing VIX will not get you into panic situation. This is the beauty, the way we need to deploy the calendar splits. I'll also show you how to deploy the calendar splits for the aggressive traders. As a conservative trader, my calendar split always has a cost to cost in the middle, and later part I'll try to increase my profit in the between by doing my so-called adjustments. It could be rolling up, it could be rolling up my put, only my sold position, and rolling down my call sold position, or else rolling up my sell with my edge, rolling down my call with my edge. I mean, I'll show you all the examples. Now we have discussed about rising VIX and the falling VIX. Okay, now let's say you have deployed this trade. Okay, let's say you have deployed this trade, and the market Nifty remain in this sideways for 2 days. Let's take an example, right? Though you have the safety of almost like 3% and 2.5% on the bottom and on the upside, let's say the Nifty is static or remains range bound between, like, let's say it made a 0.5% down and 0.5% up, and then it is somewhere here on the next day. So what you have to do, right? Before that, what is the threat of this? What is the threat of this overall trade? Okay, the only threat of this overall trade is with a quick market going up, right? What will happen if the market quickly goes up? Obviously, right, your VIX will fall. Point number 1, your VIX will fall. With the market going up, your VIX will fall is the only threat of your calendar spread. Because what happens when your market goes up, when your VIX falls, your calendar edges will decay. Though your sold position will also decay, but the calendar edges will decay in a faster time run, so that you will not get into the profit. So this is the only threat, the rising market with a quick momentum, not this market, like slowly, not this market. I'm not referring to this market zigzag, I'm referring to this market, quick momentum, right? If this happens, your VIX will also fall. The falling VIX will decay your buy position, right? What will happen if the market goes up? Let me show you. I'll try to see. Let's say your market goes up here, right? The market goes 1.5% up, and let's say your VIX is falling. So don't you think your blue line is safe only till this point? And see, now your loss will be almost like how much? 800 rupees loss within the same day. On the same Tuesday, if the market goes by 1.5% up, you'll straight away get into loss, because market going up, VIX will fall, falling VIX will decrease your so bought positions, the buy position, because we are deploying the calendar splits with an intention of rising VIX. This is the only threat of the for this trade. Let's take the other way. Market fell by 1.5%, right? Though the blue line is not giving you the safety. What did I say when the market, okay, let me show you the other way, sir. Let me show you the other way, right? Let me show you the other way. 1.5% upside, or let's say 2%, or let's say 1.5%, right? To be like more realistic, you have 700 loss now. What will happen if the market goes up? Obviously your VIX will fall, right? Obviously your VIX will fall. See, this is where you see the loss in this strategy. I'll just take minus 5% VIX fall. So right away you are into 1425 loss. This is the only threat of the calendar spread. All right, and now I'll do the other way. I'll just make the market fall by 1.5%. Check the beauty now, right? When the market falls by 1.5%, so don't you think the VIX will increase? See, now with the increasing VIX, do you see loss on the put side? No, right? Ideally 1.5%, the VIX will increase by 10% actually, right? Let me take the hypothetical example, 10%, so that's it. So falling market is very good for this strategy. See, when I say falling market, not this market, right? When I say falling market, not like this, right? Bigger movement will give you. When I say falling market, maybe small move like this, right? This market, when the market falls, the VIX will increase. The rising VIX will increase the premiums of your put and also or your calendar edges. Though this will also increase, but this will compensate the profit, the loss of your sold positions, and overall your MTM will be in profit the way it is showing here. Got it? So you got my point. What is a threat? Falling market is not the, so when I say not bigger falling market, like maybe like 1%, 1.5% is very good for the strategy, because falling market will increase your VIX. Got it? So I've discussed about the threat. Only threat is quick upside, because this will fall, this will enable your VIX to fall. Falling VIX is threat for this strategy. We have seen that. Okay, let me again reset. Let me delete. Let me get it the VIX to back to 0. Let me reset, right? We are back to our strategy. Okay, we have discussed about now I think already I've discussed this in one of my Sundays video, but again I'll repeat. What let's say I've deployed this trade on Tuesday. So on the Tuesday itself, if the market has given you 1% upside movement, right? Your blue line is not safe, right? What will happen? VIX will decrease. Right, when the market goes, we have seen the example, right? VIX will decrease and you will get into your loss, maybe right 500, 600 or 700, right? Now what will you do, right? Because you have deployed the trade Tuesday at 10 o'clock or 11 o'clock, or maybe, or else let's say the Wednesday, the next day the market gaps up, or maybe the market opens flat and then it makes a upside move. This is the only threat of your calendar spread. So what will you do? Tell me friend, what will you do? So will you exit the trade? Because overall if you look at your capital 49,000, and you will be having another 1 lakh for the adjustments. So what is 2% of 1 lakh point 1.5? 3,000. So 3,000 should be your stop loss. So basically what you can do is like, before that I'll explain you one. I wanted to show you one example. Okay, let's say you deployed a strangle. Sorry if I'm not, let's say you have deployed a strangle. Okay, the market stands here. You might have deployed a strangle on Thursday for the next Thursday expiry. Okay, so this is your safety, this is your safety. So on Thursday itself, let's say the market made a upside movement of 0.5% or 1%, right? So what will you do? Because on Thursday itself, so will you manage the delta by in terms of booking this P leg and this and just rolling up the P, so that again you'll make your strangle balanced, right? If you do so, right, we can do that, but if you do so, don't you think you are decreasing the range of your strangle, right? Day one itself, yes, this makes sense. After third day or fourth day, and the day one or the next day when the market made like 0.5% or 1%, right? If you are moving, if you are rolling up your call and getting your call here and then balancing it, right? So you are decreasing your range, and just in case if the market gives like 1%, 2% or 2.5% gap up or gap down, you'll straight away get into your panic mode and loss. So rather than this, what I meant to say is, whenever you go for strangle on Thursday, if the market gaps up, what you have to do, not gap up, if the market makes a move of 1%, what you have to do is like, do not shift your put. Rather what you have to do is like exit this call, exit the C cell with a loss, because day one, see, your maximum loss is on the expiry day. On the same day, if it even makes a 1% or 0.5%, you might be at the loss of 500 or 300 rupees, 400 rupees. But end of the day, you cannot, yes, 500 loss is okay for you to bear, but you cannot hold that trade for the next day, because your balance, your trade is imbalanced now. So what you have to do is like accept this loss, right, by squaring of the C, and go whatever points it made. Let's say it made a 100 points move, go and sell one more call at 100 OTM and make your strangle balance. That's it. You got my point? Rather than shifting the put, accept the 500, 300, 400 loss, and by in terms of selling off that, squaring of that C sell position, and go like 100 points or 150 points and then sell one more call. So what is the result of this thing? You will have one more strangle by the market in the middle. Your trade will be balanced. So why did I explain this logic here? You'll get to know. Because let's say the market was standing here, right, on the same day, Tuesday or on Wednesday, the market made a move of almost like 0.5%, 0.6%, and then you are seeing a loss of 500 rupees, let's say, because day one 500 or 400 in your calendar split, or 300, right, less than 1000 friends, less than 1000. So what I would recommend you is like, rather than shifting your entire PE combo right, rather than shifting your entire PE combo, what you have to do is exit this C leg, exit the C buy leg. Simple friends, exit these two legs, accept the loss of 500 rupees, and then what you have to do is you have to sell maybe another 18,300 or 350, matching the premium. See, I mean, it is tough for me to say whether it is like 100 points or 150 points, whatever points it made a move. So covering that points, ensuring that your trade is balanced, your payoff is balanced, just a trial and error, right? You have to do the trial and error, exit this trade and sell new call worth of 18,300 or 350. Along with that, in line to that, you have to buy the edge of, let's say, 18,600 or 18,650, ensuring that you do not have more than the 200 rupees spread between your buy and sold. So what will that make to your trade, right? You will be able to make your trade balanced like this. Let me get it to 0. That's it. The moment you do this, right, your trade will be balanced. Again, your market will come in the center, right? You will have a sort of the same, right? Your market will stand at the center, okay, and then your trade will be balanced, because you booked the loss of 500 by just sacrificing 500 rupees, okay, by just sacrificing minus 500 rupees, okay, you are making your trade balanced, right? 500 is not a big deal, because your stop loss is 3000. From 3000 you already gave, right, you already gave a loss of 500, and then you made your trade balanced again, right? This is good to hold. This is good to hold as a positional trade, and then we later will think about how to increase the profit in this middle area. Point number 1. Okay, stay with me friends, stay with me. If you're not able to understand, pause the video,